Hey there, partners. It's time for more financial statement analysis. I hope you're all ready for this today, because today, this is the biggest chapter in the book, and it's really the most exciting chapter in the book, because what it does is it translates everything that we've been doing so far into stock values. And 13 and 14 are going to do the same thing. But what we're going to talk about now is how do you know the value of a stock, and how do you use the accounting information to determine what the stock should be valued at. And if you determine the stock is overvalued, then it's a sell. If it's undervalued, then it's a buy. If it's about right, then it's a hold. So that's what we're going to talk about today, and I hope you're as excited as I am. Let's talk a little bit about what we're doing, and then we'll get into learning objective one. So first of all, just so that you're aware, a financial instrument entitles the owner to a series of payoffs. And really, any kind of investment, what we're talking about is that there's a series of payoffs, and you want to try to set a value on that. So what you're going to do is there's going to be certain variables that'll be used, and those will be used to determine the value. So cost of capital is going to be the rate, and that's the discount rate the investor usually uses to value future payoffs. And it would reflect the return that they're going to expect on their investment based on whatever the risk of the investment is. So every investor investors generally have a certain expectation for their investment. Sometimes it's higher, sometimes it's lower, but it's there. And also, in understanding of risk, the riskier the investment, the greater return that they're going to expect on that investment. And when we're talking about returns, we're always talking about average return. In other words, if you have a risky investment, you can make a lot of money, you can make a little bit of money, and there's a whole range of different outcomes that are possible. The average return would be what is the average of all those possibilities. So this is very hypothetical and theoretical and all of that, but it's very important because it establishes the connection between accounting information and the stock value. So one thing that you're going to need is going to need cost of capital. The other thing that you're going to need is what's called a forecast of future payoffs. So this would be whatever the investor expects from the investment. So the real thing that the investor is going to get is the investor, when they buy a stock, they're going to get a series of dividends, and then they're going to get a payoff when they finally sell the stock. So that, in a way, is an annuity. You have a series of payments, right? And then you have a payoff at the end when you sell the stock. So you're going to just take the present value of all those future payoffs, all those future cash flows, and add whatever the cost of capital rate is to determine what the value of the investment should be. So this future cash flows it really is the future dividends. But investors sometimes use free cash flow, and in this class we're also going to use a measure of operating income. So let's talk about the basics of valuation, what's called intrinsic value, discounting, and payoffs. And these are some preliminaries. People who invest in stocks are going to get their payoff in the form of dividends, and eventually they're going to sell the stock, whatever they get for the stock. And that's the return. That's a series of payoffs. When you think about it, every investment involves some kind of returns in the future, and so that's what's going to help us determine the valuation. With bonds, on the other hand, if you invest in bonds, you're not going to get dividends, you're going to get interest payments, and then when the bond matures, you're going to get a principal payment. So again, you have a series of payments, and then you have the principal payment at the end. So in this way, stocks are significantly different from bonds. They're also usually very different in terms of the level of risk, because stocks usually entail a lot more risk than bonds. So there's a series of steps that you're going to want to take. The first is just, as we've talked about before, this is not new, understanding the business environment and the accounting information, and then tweaking the information a little bit. That's the sandbox, to see if we can get a more accurate measure of the company's performance. And then forecasting those financial statements into the future. And then finally, using that information to determine the stock value. So let's go through each of these steps in a little bit more detail again. One is, and we've talked about this before a lot, is assessing profitability. What we want to do is we want to understand what the business is, and the way I like to talk about it is how the company makes money. What does the company do to make money? What is their business model? And it's very important to understand this. This is really the key to everything. You can't really do projections without understanding how your company makes money. One issue that's important, again, is this trade-off between profitability and turnover. Some companies are more into turnover, like Walmart. Some companies are more into profitability, like Tiffany. Other issues involve actually how the company kind of taxes its customers. So what's the company's revenue model? How does the company produce products? Is it a service company or a manufacturing company? When I say revenue model, for example, I'm talking about Netflix, right? Netflix has a subscription model. And so in order to really understand revenues from Netflix, you would need to understand, okay, how many subscribers do you have and how much do they pay? It's interesting, I was at the movies, and the movie has a monthly charge. I think it's $19.95. This is AMC. A monthly charge, you can see up to 3 movies a week, which is an incredible deal. Because if you can see up to 3 movies a week, right, if you do the math, each movie is like, these days, 14, 15 bucks, right? You can make up your money by seeing 2 movies a month, and you've already made a profit. From the movie theater's perspective, it's also a great deal, because what they can do then is they can fill up empty seats. And they might be able to control how many tickets can be sold, given out through this membership kind of thing they use. So converting over to the Netflix model in a real movie theater is an interesting idea. Anyway, what you would want to do is you'd want to understand what is the company's revenue model. The next step is the sandbox, is understanding, adjusting the financial statements. Now, this is a little off center because I think I'm adjusted it. I don't know why it's off center. It's kind of weird. It's just saying that. Oh well. I can adjust it. There we go. Right, that's a little better. Anyway, so this is the sandbox. What you do is accounting does not always describe what's really going on. So what you're doing here is you're going through the financial statements and making little tweaks here and there to try to get a better idea of the company's performance, a better measure of the company's performance. Because this is going to help you to predict what's going to happen in the future. So for example, if the company took a restructuring cost, we know that restructuring costs is a very conservative way of accounting for things and recording expenses now. And restructuring costs are not likely to recur in the future. Therefore, what I would say is, take it out. Take the restructuring costs completely out of the income statement because it's not predictive of what's going to happen in the future. Forecasting financial statement information means estimating the cost of capital and coming up with a cost of capital measure, which is going to be risk adjusted, and you applying that to your forecast. So obviously it says here you're going to need to create a forecast and then apply the cost of capital to that in order to figure out the present value. And your valuation model is really going to rely upon this cost of capital and the projection. Because what you're going to do is this is an investment, it's going to have a series of payoffs which you estimate. You take the net present value of all those future payments, future cash flows, and that's approximately what the value of the investment is. Now, you can't really talk about this without also talking about intrinsic value. And what intrinsic value is it's a measure of what the real value of the company is. And what we say is that intrinsic value is split into 2 types of valuation. There's the value of the equity, and there's the value of the debt. So really, investors would need to value approximately what the stock is worth, and then also analysts would want to value what the debt is worth. And if you add all of that together, you have an approximation of what the entire firm is worth. Now this theory, by the way, when we say debt, this theory really means total liabilities, because obviously assets equal liabilities equals equity. So you want to use total liabilities when you're doing this. And you're going to need to know time value of money. I think it's a little outside the scope of this. Everyone who's taken this class should have taken some accounting classes and also should have taken a finance class. So this is somewhat outside the scope of what I'm going to teach here. But you need to know how present value works. And what we're going to do is once we estimate our future payoffs, we're going to take the present value of all of those to determine again what the value is. And then you're also going to have a lump sum. So you'll have a series of annuities, and then a single lump sum when you finally pay everything off. So here's an example of a lump sum investment. And I'm just doing this to refresh your memory, but I'm not sure why this is going off screen. Oops. So let's say we have $100 that we're going to receive 2 years from now, and the discount rate is 11%. So we would want to look up what the present value of a single sum for 2 years at 11% is. It's 0.81162. I'm old, and I actually like to use the formula of 1 over 1 plus r to the n. This formula right here. I actually like to use that formula when I do things. I don't even like to use the Excel NPV formulas and all these Excel present value formulas. I like 1 over 1 plus r to the n. That's how I like to do it. So here you can see they're looking at this, that $100 for 1 year would be 90.09. So, and for 2 years would be 81.16. So basically the way the math would work is $81.16. That's the present value. If you interest on that is $8.93. So by the end of the first year, if you invested it, you have $90.09. Then you charge 11% on it again. You have $9.91, and then the balance at the end of the year would be $100. So this would be what we call a lump sum, present value of a lump sum. We also have what's called an annuity. An annuity would be a series of payments that occur at equal time periods, over equal time periods. So these payments are all equal. They occur evenly over time, and they all use the same interest rate. So here's an example. It's not showing you the formula here, but you can look up the formula on the web, and you can use a calculator, or you can use Excel. But basically, 11%, what they're doing here is they're using the same formula. This happens to be how I like doing it also, is that let's say you have $1,000 a year for 4 years at 11%. What is the present value? And by the way, the first payment here occurs at the end of the first year. So you would take the first payment back 1 year, the second payment back 2 years, third payment back 3 years, and fourth payment back 4 years, using 1 over 1 plus r to the n power. So if you add all these up, you get $3,102. That's the present value of 4 payments of $1,000 a year at 11%. And here you can see a diagram of how a lump sum works versus an annuity. So here, they're changing the problem a little bit. What if this isn't really so relevant, but it's interesting. So what they're saying here is that if the present value is $3,102, that's equivalent to $1,000 a year for 4 years. So if you invest $3,102 at 11%, then each year you can take out $1,000, and at the end you'll have zero. Now they're pointing out something else. Let's say someone invests $1,000 a year for 3 years, puts in $1,000 a year. How much are they going to have at the end of 4 years? And the answer to that is 4709. That's what's called the future value of the annuity. There's not many applications of future value in what we're doing in valuation. Believe it or not, we almost always teach future value, but the surprise here is that it's actually not very useful when you're valuing investments. Now, if you have debt, debt is a little bit different. Debt has what we call coupon rate, face value, and market rate. Coupon rate is the rate that determines the annuity payments, the cash flows. You would use the coupon rate to determine what the interest payments each half, let's say, are going to be. So let's say you have 20-year debt. The face value is the actual amount of money that was borrowed. This would be the principal value, the amount of money that the debtor is required to pay when the debt matures. And the market rate is the rate the investors expect the debt to return. So the market rate is not necessarily the same as the coupon rate. If the coupon rate is a little low for investors are going to have a higher market rate, and therefore the present value of this investment is going to be low, well below the face value, and that can go in the other direction too. So if investors feel the debt is, the coupon rate is too low, then the market rate, feel the coupon rate is a little too high because the debt is less risky than the coupon rate might indicate, then the market rate would be lower, and therefore the present value, i.e. the value, investment value of the bond is going to be higher. So you can apply these present value formulas to debt. And let's say we had a very simple debt, 3-year bond, 9% coupon rate, face value of $1,000, market rate of 10%. Again, I hope this is a review for everybody, and that's why I'm going through it a little quickly. Interest would be $90 at the end of each period, because $1,000 times 9% is $90. And then at the end of the third period, there's a $1,000 payoff, because that's the face value. So you have here a lump sum of $1,000. That's 1,000 times 0.75131, or $751. And then the annuity is $90 at the end of each period times 2.48685, or $223, and that gives you a present value of $975.13. So the investor is willing to pay $975.13. So this would be a situation again, because investors, the company's paying 9%, but investors think it's really worth, they should be getting, based on their understanding of the risk of the investment, they feel they should be getting 10%, and therefore the value of the investment itself is worth less than $1,000. It's only worth $975. Now you can look at this as a stock, and this is where things get interesting. Let's say that you project that this company is going to pay a $90 dividend at the end of each year, and then at the end of 3 years, you're going to sell it for $1,000. So you would do present value of a lump sum, 3 years, 10%, $751.31, and then present value of the dividends, which would be an annuity, which would come to $223.82, and therefore the present value of this equity instrument, it says here debt, but they really mean equity, the present value of this equity instrument would be $975.13. So really when you're valuing an investment, all you want to do is you want to project the future cash flows and then find the present value of those cash flows, and that's what the value of the investment is, whether it's debt or equity, options, anything else at all. This is how we value investments. So discount rates, there are various different discount rates. You're going to use, your discount rate is going to be based on what you perceive the risk to be. So if you have debt, you could have cost of debt capital, cost of equity capital, and they're going to be different because debt tends to be less risky than equity. Now, most companies, or many companies, have both. So if they have debt capital and they have equity capital, then what is the company's cost of capital? And what you need to do is you need to use WACC, weighted average cost of capital, in order to figure this out. Because we want to see what's the real value, the overall cost of capital for that company. So investors, when they invest, their cost of capital is going to be based on two factors. One of them will be the time value of money itself, and that's why we apply present value. And then the other is going to be the cost of risk. The risk is that you could lose your investment, or you could lose a portion of your investment, or really that you could get a lot more than you expect. That's also risk. Risk can be positive, risk can be negative. But when we're talking about risk, risk is not being sure of how much money you're going to collect. So if we go back to our bond example again, there's risk here because there's a risk that a company might default. They might not make an interest payment, or they might not be able to pay the future value. On the other hand, with equity instruments, there's also risk. Risk that they might miss one of these dividends, or all of them. And there's a risk that you're not going to be able to sell the stock for $1,000 at the end of 3 years. That is also risk. So risk is really, when we're talking about risk, students tend to think of risk as negative risk or risk of loss. But risk is risk of gain or loss. It's any straying from what your expectation is.